Hello, everyone, and welcome back. Today is the fourth session of discounted cash flow evaluation with Python. Today is the day we will be going over the model and provide inputs to it and drive evaluations and learn how to utilize it. If you are watching this session for the first time and are comfortable with discounted cash flow model structure, understand corporate finance, feel free to keep watching. Otherwise, I would recommend going and watching the first, second, and third sessions, where I covered high-level concepts of corporate finance, investment principles, investment valuations, and the model structure. The link to this Colab file is in the description of this video, which contains all the slides and the model, all the codes that you need. If you click there, this Colab file, which is in front of me, will be open for you, and you can click on File, click on Save a Copy in your drive. You need to have a Gmail account, and once you click in there, a new Colab file will be opened, and that would be in the location of your Google Drive, and you have sole ownership to the file where you can make changes and utilize the model. So let's recap about investment principles quickly and then dive into valuations. We talked about the value of any investment is all the expected future cash flow that is expected to earn in the futures. We discount those cash flow at the rate that reflects the risk of those cash flows, which we call that discount rate, and we arrive at the value of an investment. I bring this slide brings everything home. The value of an investment is the future cash flows, and this triangle, which has the risk, the reinvestment, and the growth, keep every component of the model accountable of the other one. Let me elaborate. We talked about the grocery examples when you wanted to go and open a second location and you needed capital to do so. And you have to go to your bondholder or your shareholders to raise that capital. Well, that's reinvestment. And that also comes with risk. The second grocery store could fail and result in disaster, or it could be even better than the first one and you become better learning experience and you open the third one and so on. So it all comes together. You have a risk, you have growth, and you have reinvestment. And you have to provide the input to the model in a sense that they are tied together and keep each other accountable. The model structure, more level and details, well, you have your revenue, you have some profit margin, we call it operating margin. You arrive at operating income. You pay your taxes, we call that after-tax operating income. You subtract capex, depreciation, change in working capital. That's essentially the reinvestment to keep the business going on. And you arrive at the free cash flow. And that free cash flow to the firm belongs to bondholder first. And then if there is anything left, that will be for the owners of the business, which is the shareholders, the stockholders. Once we can compute our free cash flow to the firm in the future, we discount that at the cost of capital, which is weighted accordingly based on the cost of equity and cost of debt. We arrive at the present value of the investment. We also talked about a terminal value. In a DC evaluation, you have a closure. When you believe your investment is mature and it's going to grow only at the rate of economy, which is real GDP growth plus inflation. So that terminal value is essentially the free cash flow to the firm times 1 plus G, which is G is your perpetual growth, divided by R minus G. R is your discount rate, G is your perpetual growth again. That is in the future. You discount that to the present, you are at the present value of the investment. Now, value of asset, value of an investment, value of a business, value of a stock are all the same things. They are cash generative assets, and stocks are nothing different than a fractional ownership in a business. So with that said, let's get started. Once you have the Colab file, this section is called a cell. When you execute a cell, all the lines in a cell is ran. Here I import the libraries that we need. In order for you to run a cell, you can click on this play sign, or you can hold shift and press enter on your keyboard. When you hold shift and press enter, they're interchangeably equal, and the cell is run and all the codes are registered, and it's registered in the memory of the computer. There are functions that are needed to utilize the model, and they are written in order for them to be applicable. The computer needs to understand the functions and registers, so you need to run every cells that are provided. So here we are going to install or import the libraries that we need. Then there are some functions that are needed to perform the discounted cash flow evaluations. So let's run them. This function, evaluator multiphase, this is the function that actually takes all the inputs that we need to drive evaluation of a business. It takes about 35 inputs, and this is the one that we'll be using. There are some other functions that I will just run them. Those are for Montecarlo simulations, DCF simulations that I will be covering in the next sessions. You don't need to worry about it, but it doesn't hurt to run them. So I decided to value Chipotle today. Chipotle is a Mexican restaurant. It's like a fast food casual, but a little bit more premium. People will be dining in as opposed to just like McDonald's or other places that people would get their food for to go. It's more catered towards business professionals, individuals. They sell burrito, bowls, guacamole, tacos, all that good stuff, which are very delicious. And it's a high quality food and high quality business as well. When you look at the financials of the company, business is very not complicated. It's very easy to understand. It's just like a restaurant, a little bit more premium, but the price is not really premium as much in a sense compared to McDonald's, Burger King, Taco Bell, KFC, or other places that you might have come across. They have about 3,000 locations in United States so far. They were founded in 1994, and they are going to grow more internationally and opening more stores as well as domestically. So I thought a Sankey chart would be a great representation for visualizing how revenue flows through this business. So think of that 3,000 stores. They collectively generated 9.2 billion for the trailing 12 months, for the past 12 months. Out of that 9.2, well, they had to take care of their vendors, their suppliers, where they bought their tomato, their chicken, their steaks, and so on. So the cost of sales accounts for 5.5 billion. The rest of it we call in accounting gross profit. From that gross profit, they have to take care of the operating expense. Operating expense, to state the obvious, is the expenses to get the operation going on. For instance, the employee salary that you have to pay, the rent for those places, the depreciation, amortization for the ovens, the equipments that are in the store. By the way, depreciation, amortization are real cost of doing business, and that accountant takes account for it. I can give you an example. Let's say let's say for Chipotle, they buy an oven. The oven has a lifespan of 5 years. At the end of year 5, the oven has to be replaced. Even though you may pay for the oven in full today, if you pay cash, for instance, accountant will depreciate it over the lifespan of it. So the depreciation and amortization would be reflective of how much revenue you earned over the course of the lifespan of the equipment that you had in the business. And if you don't take account for it, Wall Street likes to call it EBITDA, earnings before interest, taxes, depreciation, amortization. When people put it back to arrive at, they can put it back to arrive at the free cash flow to the firm, maybe for that given year. But if you want to see if the free cash flow to the firm is reflective of what the business is going to earn in the future, then you have to take account at some point in future, maybe year 5, year 10, whatsoever, equipment has to be replaced. So you had a high negative free cash flow. Well, if you take that into account, then that's totally fine. Take EBITDA into account, or take EBIT and then add depreciation and amortization back into it. But be open, do it with open eye. Later in the future, you have to take account for those reinvestment, the equipment that you need to buy to get the business going on into the futures. So once you get your operating expense paid, you subtract it from your gross profit, you arrive at your operating profit. And from there, if you pay your taxes, then you arrive at after-tax operating profit. And then once you subtract your reinvestment, you arrive at the free cash flow to the firm. So let's look at the financials of Chipotle. Since 2013 through trailing 12 months, the revenue growth from 3.2 billion to 9.2 billion, almost 2.8 fold. At the same time, if you look at the assets on the balance sheet, they also grow by about 3 times. Again, going back to the point that I made, for growth is not a free gimmick. Any business that needs to grow, they have to reinvest back to the business, and you can obviously seeing it at the assets level of Chipotle. The gross operating margin has been, 37, 37. They had a blip here. I think there was something wrong with the lettuce or chicken at some point in 2016, and then it's back around 40%. Operating margin went from 17%. We had this blip in 3-4 years, and then back at 15.8. Restaurant businesses, dining business operating margin is about 16%, and Chipotle is about average on that sense. And as a result, we are seeing that operating income has grown from 540 million to about 1.5 billion for the trailing 12 months. So it's a cash flow positive business. The next thing I would do would be looking at the return on investment, return on capital. You can compute it based on the balance sheet and operating income numbers that you have, or you can go to Bloomberg or Yahoo Finance or Ticker in this case that I go to see what the ratios have been. And you can see the return on asset around 10%, on capital about 20%, return on equity around 30%. So it's easily hitting its hurdle rate, its cost of capital. So looking at the business and fundamentals of it, I'm not going to cover a lot of it here because I'm not diving deep into Chipotle valuations. I want to show how to utilize the model, but I arrive at the conclusion that the business is a high quality business, high return investment, simple. There's not much R&D going on. People behavior of eating food is not going to dramatically change in the future. There's a lot of room to grow for them. There are a couple of things I don't like about the board, and which I don't get into them here, but the major thing was, three individuals make about 80% of the total insider ownership. And the other thing I found was the CEO of NRG sitting on the board, and quite frankly, I don't know what is he doing there. NRG is an electricity company producing electricity, solar panel, and so on. Chipotle restaurant business. I can't connect the dots. Maybe you can tell me. But overall, I think it is a high quality business. So let's get to the valuations. The functions that we need to use is the valuator multi-phase. If you have a question mark at the end of it and execute it, which I press Shift and Enter on the right side, you get all the information that the author made available about the functions. As far as the parameters that goes into the model is the risk-free rate, the equity risk premium, the cost of equity, cost of debt, and so on, which are here. You can read more about them. I put some description about each of them. The risk-free rate, as we discussed, is the dominant currency which you perform the DCF, and it reflects the real GDP growth plus inflation. If you're doing it in the United States dollar, the USD, the 10-year T-bond rate is reflected. As of first week of September, the risk-free rate has been around 4%. The equity risk premium, this number is how much you would expect a stock to earn. Dr. Aswath Demodron publishes implied equity risk premium every month on his website. He takes the analyst estimate, which Edward Yardini publishes, which I think comes from 80 analysts that tracks S&P 500. And they look at the dividend and buyback, how much stocks are expected to earn. And then you can use IRR function in Excel because you have the level of index, the dividend buyback is a cash flow into the future. You can discount them back to present. You can arrive at the internal rate of return of the stocks. And if we Dr. Damodaran called it implied equity risk premium, it's because it's implied. It's not explicit. No one knows what future holds, but you can make some estimates or assessment what the stocks are expected to earn based on where they are and what the estimates are in the futures. And then when you use about 80 analyst estimates, you would be biased, but it would be on both sides. Some analysts are pessimistic, some analysts are optimistic. So things would average out each other. So you need the equity risk premium, whether you want to use that number that Dr. Damodaran publishes or you want to have your own number. whatever you think, but this number has to be reasonable. The equity value is the estimated equity of the business. You may be saying, gee, you are asking me equity value, but I'm using this model to actually value the business. And I totally understand where you're coming from. The thing is, when you want to assess the cost of capital, you need to weight equity and debt accordingly to arrive at the cost of capital to discount those future cash flow to the present. You can put an arbitrary number here or use a market value of your business to arrive at a number, and then whatever number you get, put it back into this and run the model again and see what number you get. After several iterations, these numbers would convert. Whether you use the equity value from Yahoo Finance or whatever, the market cap of the business essentially, or whether you use some arbitrary number or put some multiples in front of sales or EBIT or EBITDA, whatever, that works fine. But this is a circular problem that you may think the model has. It's not a bug. It's a feature. So you can decide however you want to deal with it. But if you go over the mechanics, you're going to see this is not going to change your valuation number dramatically. This one is the debt value. You can read it on the balance sheet how much the company owes, or you can look at the bond market and see what's the market value of the debt of your company. If the company that you're valuing is public, you can refer to market value of that. But if it's private, then you have to make some assessment what it would be, or go based on book. We have the cash and non-operating assets. Here we are looking at things that are not part of the operations, because we are valuing the operations, we are valuing the business. Anything that is not as in form of cash or debt is on the side, and we will bring it into the account at the last. Unlevered beta, as I talked about the risk and return model in the past, we have CAPM, capital asset pricing model, or arbitrage pricing model, multi-factor model, or accounting models. Whichever you think works for you should stand as a proxy, as a relative measure of risk. The model that I have uses CAPM, and it requires unlevered beta, and it leverages it up according to your debt and equity ratio that you provide to it. The unlevered numbers, as explained how the mechanics of it is, and Dr. DeMoran also covered it during his valuation course. You compute the beta, you adjust the beta according to the debt to equity ratio of the companies that are doing the same thing, and then you leverage it up according to your business, and the model is going to take care of that for you. You just need to supply the unlevered beta, not the levered beta. The regression beta that you compute is levered. Then the next parameter the model wants is the year that beta begins to converge to terminal. If you notice, I have two unlevered beta in the model. The first component is unlevered beta today. The second component is terminal unlevered beta. I mean, at maturity, when your business is mature, what the risk profile of the business is. For Chipotle is about 0.9, and it's going to remain about 0.9. And it's a restaurant, simple business. Nothing is going to dramatically change. But let's talk about a startup. For instance, let's say you have a AI company, or you have a metaverse company, and you're going after a market that is uncertain. As your business becomes more mainstream, more people will be buying your product, your goods and services, the risk of your business is going to be reduced. And that unlevered beta is supposed to take that into account. Therefore, the model has that flexibility. Let's say if you have a startup that you start from 1.7, 1.8, and gradually over the evaluation period, you can converge to 1.1, 1.2, or 0.9, whatever you think that number is reasonable. Otherwise, for mature business, this feature is not much needed. Your unlevered beta and terminal unlevered beta are usually the same. The next parameter is a year, the specific year that the beta begins to converge to the terminal. Again, going back to a startup, if you start from 1.8 and you converge to 1.2, then the model needs to know when that convergence should happen. It's going to take care of that convergence for you. It just needs to be told when to take care of that for you. The next parameter is current cost of debt pre-tax and the terminal cost of debt pre-tax. And again, the year that the convergence is going to take place. And again, this is because if you have a firm that is leveraged up, it has a lot of debt, but it's perhaps cash flow positive, you're going to be using the cash flow to pay off debt when you do that, the cost of capital is going to change. Your cost of debt's going to go lower, as well as your cost of equity. And the model has that feature to take that into account. But then it asks again, when does that convergence should take place? You can say it immediately from next year or from year third to the end of the valuation. And the next two parameters we will be providing is the current effective tax rate and the marginal tax rate. The thing is, interest expenses are tax deductible. They provide tax benefit in a sense. So the model is going to take the marginal tax rate and the pre-tax cost of debt and is going to adjust the pre-tax cost of debt for after-tax cost of debt to reflect the interest expenses benefit. Effective tax rate is the tax that your company is paying today. Again, let's talk about a young company. Usually young companies don't pay their marginal tax rate, but then as they mature, their tax rate is going to be higher because there's less reinvestment going to take place. And as an evidence, you should be seeing an old company, a mature company, paying their marginal tax rate. And the model is going to converge your effective tax rate to the marginal tax rate, but it also again needs to know when that phenomenon is going to kick in. For the pre-tax cost of debt for Chipotle, I assess 0.6, and for the sake of showing you how it works out, I'm putting 0.5 for the terminal cost of debt, and I think rates in the 10-year in 10 years from now are going to be a bit lower. But again, it doesn't change my valuation as much because this company specifically doesn't have much of debt. They only have about 3.8 billion in debt on their balance sheet. So it's not going to move the needle, but it's just more for the sake of showing you the case how you can utilize that feature. The revenue base is usually the trailing 12 months, but essentially it has to be reflective of a normal year. Let's say your company has been affected post-COVID for whatever reason, and the trailing 12 months is not reflective, you can adjust it. So essentially the model uses the revenue base, you give it some number as a baseline, and based on the growth rate that we will be assigning in these parameters, it's a start building up. So let me explain what. For Chipotle, I think 9.2 billion is reflective of a normal year for them, given that 3,000 stores that they have. Over the next 6 years, the growth starts from 11% and it's going to accelerate to 16. From year 6, from 16%, we will be seeing growth going to 14 and gradually getting to 9. And then over the 6 years after that, from 9, you're going to go from 8 to 4%. So if you look at the revenue columns here, we start from 9.2. We grow that number by 11% for next year, which is, this is 1 year into the future. We are at 10.3. The next year, we grow that number by 12%. The year after, we grow by 13, 14, 15, 16. From there, the growth is going to slow down. We go from 16 to 14, 13, 12, 11, 10. And then growth is going to slow down further, go to 9, 8, 7.2, 6.5, 5.6, and so on. We get to 4%. If you see here, the revenue growth rate in cycle 3 at the end of it has to be equal to the risk-free rate because, again, as I mentioned earlier, the R minus G is extremely sensitive parameters in the model, and if you are not careful with that, you're going to come with funny valuation. Let's say if your growth rate at the end is greater than risk-free rate, we said implicitly you're saying your company is going to grow in perpetuity at the rate higher than the economy, which if you do the math, you will see your company is going to be larger than the economy, which doesn't make sense. The number that you would get is not going to be larger than the world GDP, which is about 90 trillion. Who knows what that is exactly? But the thing is, you're saying your company is going to grow at the pace larger than the growth rate of the world, which is not possible in perpetuity. Then the next thing that the model is requiring is when this convergence is going to take place. So again, for revenue growth rate, the cycle begins next, year 1, and then it's going to converge to 16. But the model is asking, when should I go from 11 to 16? Like when the convergence should take place? And I would say to start from next year. So 11 becomes 12 next year. If I put this 2, then we will have 11 for 2 years, and then it starts converging, and at the year 6 we're going to arrive at 16. So again, this is a feature that the model has. If you have high growth for a while and you want to sustain it for several years and then bring growth down, again, the model has it. The next parameter that the model has is the sales to capital ratio today and the terminal sales to capital ratio. This is supposed to take your reinvestment into account. So if we go back to your chart, so we had growth, we had reinvestment, and we had risks. Again, growth is not free gimmick. In order for them to grow, they have to reinvest. And the way that the model takes that into account is based on revenue growth. So let's look at their balance sheet really quickly. They have about 7.5 billion in asset, but it also contains their cash. We need to look at revenue divided by sales to invested capital. Cash is not invested. It could be in treasury bills or so on, but it's not invested in operations. So take that into account. So 9.2 billion in revenue, roughly speaking, divided by 7.5 minus 1.7, which is their non-cash operating assets. We arrive around a ratio of 1.6. What it means for every dollar that they reinvest back to the business, they bring $1.6 in revenue, $1.60. So if you want them to grow by 1.6 million, they need to reinvest about $1 million back into the business. The model is going to use their sales to capital ratio to account for reinvestments. And again, has two components for sales to capital ratio. One is current, which is today. One is at the end of the valuation. And then when the convergence is going to take place. The reason for that is, let's say you have a business, you have invested a lot already in the equipment, in the land or whatever. Let's talk about manufacturing for a second. That already provides a buffer for you for reinvestment. So you don't need to open another manufacturing firm in a sense unless you hit the bottleneck in capacity, and then you have to open a second one and so on. So if that's the case, the model has that flexibility, which you can assign higher sales to capital ratio now relative to your actual numbers on the balance sheet, because you can get more revenue relative to the assets that you have in place right now until you hit the capacity, and then you have to open new plants and so on. For Chipotle, I'm starting from 1.7, which is how we calculate, and I'm gradually reducing to 1.3. It's because I think as they're growing, there will be more competition, and they're expanding internationally. They may not be able to pull it off as well as they've done in the States. Like they found their niche and the formula how to open stores rapidly in the States, but not internationally yet. So I feel comfortable, start from 1.7 and over the next 18 years, bring it to 1.3. And again, the model is going to ask when that phenomenon is going to kick in. When does it have to converge from 1.7 to 1.3? And as you see, the sales to capital ratio starts from 1.7 and gradually it gets reduced to 1.3 over 18 years. The other thing is the operating margin today. And the next parameter is the terminal operating margin. This is the margin that your business is expected to earn in perpetuity. And I'm expanding that number from 15 to 17.5. And again, the model asks when that phenomenon is going to kick in. Again, I'm going to say, okay, start doing it from year one and so on. Again, if you have a startup business, you may start with low, like single 1% or 0% operating margin. And as you build a scale, you get larger, your profitability is going to kick in. You can expand that number to become high. You can get your operating margin to be positive and larger. But you need, again, checks and balances. Look at the industry averages, sector averages, looking at your business versus other competitors, where they could be landing. The relativity analysis you need to do to come up with a reasonable number. Going back to saying all models are wrong, some are useful. And if you put garbage in there, you get garbage out and come up with funny valuation that wouldn't make sense. The next parameter in the model is the additional return of cost of capital in perpetuity. The thing is with the DCF model, as we said before at the top, let's go back to the model structure for a second. We said the at the terminal year, your reinvestment should be taken into account. And this model, this DCF model, specifically assumes that in perpetuity, you will be earning your cost of capital. If your business is well run, as it's supposed to be, it's going to earn your its cost of capital, which is the mixture of cost of debt and cost of equity. If it's run better than average, it may earn higher than its cost of capital, and therefore you don't have to reinvest as much into the business. And if it is not hitting its hurdle rate, so it's a bad run business, which is they're destroying value in a sense, then they have to reinvest more into the business to keep the operations going. This is the big assumption in the DCF, which is very reasonable, but you have to be also reasonable in terms of how you arrive at those numbers. We use CAPM and the cost of debt to arrive at the cost of capital for the business, and we are going to use that to back out how much the business needs to reinvest back into itself. So expected growth rate is equal to reinvestment rate times return on invested capital. And we have the return on invested capital based on CAPM and cost of debt, so we can back out how much it has to reinvest. Again, all these mechanics and calculation and mathematics are taking place in the model functions, so you don't have to do it, but you need to understand, the structure and the reasoning behind them. So this specific parameter is used when you have a business that is earning higher than cost of capital and you think that's going to hold water in perpetuity. Warren Buffett, Charlie Munger, or other businesses, other investors out there, they call it the moat. Again, moat is a very vague term, and I need a way to understand how to measure it. Like I can just, this business has moat because XYZ, or the brand. In order to quantitatively answer that question, you can look at the fundamentals of the business, looking at the return on invested capital and seeing if the management have been able to pull that off, if they've been able to consistently hit their hurdle rate, their cost of capital. And in case of Chipotle, I'm seeing it historically, their return on capital has been about 20%. And I think they would be able to do, given that their cost of capital should be around 8, 9%, 10%. I'm giving them 2% credit. It means they're going to earn about 12% in perpetuity, which is reasonable. So from 20, that can, be eroded to 12%. But again, that's because I'm using history as a guide, and things could change into the future. But I'm doing the evaluations today, and if you disagree with that, by all means, you can, again, do your own valuation. Or you think 2% is not enough, they would be able to get to 4, 5, 6 whatsoever. You can do it. The next thing is asset liquidation during negative growth. So similar to sales to capital ratio, that they had to reinvest back to the business to grow the business. If they are shrinking and they're selling assets to cease to exist and returning those capital to the shareholder and the bondholder, you can assign a ratio here. So this numbers can be can be negative, could be positive. It's essentially the sales capital ratio times this, whatever that number is. And if that's negative, this model is going to assume it's zero. It means you're not selling assets and getting rid of the assets in place. But if your valuation is a company that is in decline and you're selling assets, and you can use this number to come up to a valuation that is reasonable relative to the story that you have to say. And the next parameter is the current invested capital. Again, they have about 6 billion capital invested. So it is going to be used to calculate the return on invested capital. So let's dive into it and see what we have in front of us. Think of it as an Excel file. Well, you have an Excel, you have columns and rows. This is essentially what that is. We provided this input to the model, and we arrive at this valuation. So let's review it. So we supplied the beta, the unlevered beta, to the business, to the model, and the model leveraged it up according to the debt and equity ratio that we provided to the model. So we arrive at a 0.95. The cumulative cost of equity, again, is calculated based on the equity risk premium times beta plus risk-free rate. That's your cost of equity, and this is cumulative weighted average cost of capital. This is equity risk premium that we supplied to the model. The projected after-tax cost of debt, which was pre-tax times 1 minus the tax rate. Then you have the revenue growth rate, which we supplied here, 11, 12, 13, and so on. And the revenue is grown accordingly based on the revenue growth rate and the revenue base that we provided. The next thing is margin. So we said the margin is going to go from 15 to 17.5, which we observe here. Over the valuation period, the margin goes from 15 to 17.5. Here is EBIT. EBIT stands for earnings before interest and taxes. Essentially, revenue times margin gives you EBIT. This is your sales to capital ratio. We set from 1.7, we go to 1.3. So again, as you see, 1.7, 1.67, 1.65, and so on, we arrive at 1.3. The tax rate, the effective tax rate that Chipotle pays right now is about 24%. And gradually over the valuation period, this number goes to 25. We subtract taxes from EBIT. We arrive at after-tax operating income. So this is just a simple calculation based on the other two columns. This is your reinvestment. Again, we talked about revenue growth divided by sales to capital ratio to come up with the sales reinvestment. So when the revenue goes from 9.2 to 10.305, they need to reinvest about 600 million back to the business to get the growth. Here is your invested capital, where we started with 6 billion. That's how much is on the balance sheet right now. When they reinvest another 600 million, that invested capital next year on the balance sheet should be around 6.6. And we just keep doing this until the end of the valuation. So the invested capital is going to grow from 6 billion to 36 billion. And here is your reinvestment rate. Reinvestment rate is your reinvestment, that's 600 million divided by after-tax operating income. When we take that into account, we arrive at the free cash flow to the firm. We discount that free cash flow to the firm according to the cost of capital that we calculated. And then we arrive at the present value of the free cash flow to the firm. So this is essentially the whole model. We keep doing this. And this is your terminal value of the free cash flow to the firm, which is 25 billion in present value. You sum them up, the value of operating assets come to about 39 billion. The cash and non-operating assets about 1.7. When we add cash and we subtract debt from the value of operating assets, we arrive at the intrinsic value of the business. This is how much is left for equity owners of the business, the shareholders, the stock owners of the business. This is how much intrinsic value they own. The stock is around trading, or the businesses, I should say, is trading around 51 billion. So I find Chipotle to be overvalued. But again, this is a point estimate. I am not sure what the operating margin would be. I think this number should be somewhere between 12 to 23. But if you hold the gun against my head and I have to come up with a number, I come up with 17.5. But I'm having a distribution in my brain right now. And I need to deal with this uncertainty because all of these numbers are point estimate. However, the world is a continuous place. It's not a discrete place. We need to think of numbers as a range of possibilities, not just point estimate, and as well as probabilities around those estimates. So let's say actually, what if they earn 3% instead of 2% in their cost of capital in perpetuity? So let me actually do the calculation here. So let's say instead of 2%, which gave us 37, we're going to do 3% in perpetuity, right? We just change one input, and then we arrive at 39. Or what if they do 1% above their cost of capital in perpetuity? Then we arrive at 36. What if the operating margin expands to 18 and this one remains at 2. So we went from 37 to 38.98, almost 39. Every input that went to this model is coming from a distribution. There's a high and there's a low to the bound of these numbers. In order to deal with that uncertainty around of every estimate that went to this model, I've also created a DCF simulation or Montecarlo simulation, where we can provide not a point estimate to this model, but a range of numbers with probability assigned to those ranges to come up with a range of intrinsic equity value of the business. In the next session, I will be providing a range of inputs to the model, and we will be arriving at a range of intrinsic equity value as opposed to a point estimate. So with that said, I hope you found this session and this series of discounted cash flow valuation with Python useful. I thank you very much for listening, and I see you in the next video.